Welcome to Value Vesta Daily, where today we're breaking down the absolute paradox of Marvell's Q2 fiscal 2027 earnings report. Look, if you've been watching the semiconductor space at all lately, you already know this sector is literally the heartbeat of the global tech economy right now. And Marvell, well, they've positioned themselves right smack in the center of this massive artificial intelligence infrastructure build-out. But here's the kicker. What happens when a company seemingly does everything perfectly on paper, yet the market reacts with just a harsh, brutal sell-off? That's exactly the mystery we're going to unravel in today's explainer. Okay, let's just dive right into this massive number for a second. $2.739 billion. I mean, wow. This represents a staggering, record-breaking quarter for Marvell. They came in $39 million above their prior midpoint, and that's up an incredible 37% year over year. To put that into perspective, their data center revenue alone surged by 46%. By all traditional metrics, you're looking at a company firing on all cylinders, perfectly executing its vision, and completely capitalizing on the AI gold rush. But here is the real mystery we're solving today. How on earth does a company beat revenue expectations, raise their future guidance, brandish a massive $120 billion Google headline that totally dominated the news cycle back in August, and still watch its stock violently dump in after-hours trading? Like, what gives? Was this fundamentally a broken story, or was it simply a market that had already priced in this mythical, flawless future and then just decided to panic when it was handed merely a highly successful reality? Here is the roadmap for how we'll deconstruct this today. First, the record earnings paradox. Second, AI infrastructure first principles. Third, demystifying that Google warrant. Fourth, financials and growth trajectory. Fifth, the bull case versus the bear case. And finally, valuation and your investor checklist. All right, moving right into section 1, the record earnings paradox. Let's look at what the market saw on paper versus what they actually felt. The numbers are just phenomenal. Revenue was a clean beat. Data center revenue, which is acting as the absolute engine of this business right now at $2.172 billion, was a massive beat. Non-GAAP earnings per share came in at 94 cents versus the 93-cent expectation from the street. They even generated $605 million in operating cash flow. The data center is absolutely doing the heavy lifting here, making up 79% of the total company now. But the disappointment we saw in the market is also very, very real. To understand that disconnect, we really have to look under the hood of the technology itself. Which brings us to section 2, AI infrastructure first principles. Think of a modern AI cluster as a bustling, high-tech metropolis. It's an AI city. NVIDIA and those custom XPUs, they are the massive, towering skyscrapers where all the heavy computation actually happens. Power is the electrical grid keeping the lights on. But you know what? None of that city works unless you can move information, the tokens, between those buildings at literally the speed of light. That's where Marvell comes in. They provide the crucial electro-optical highways that allow these skyscrapers to talk to each other. They sell the highway system that those high-powered engines require just to function. And this brilliantly illustrates their immense economic moat. Training a frontier AI model is essentially a massive conversation happening among tens of thousands of accelerators. As these AI clusters scale up, standard copper wiring literally starves the chips of data. It's just too slow, and it runs way too hot. Photons carry drastically more bandwidth per watt once you leave a distance of just a few centimeters. That's just physics. That makes Marvell's optical digital signal processors, the DSPs driving 800 gig and 1.6 terabit optics, and their switching silicon, absolute, non-negotiable necessities. They take a messy analog photon stream and turn it into clean, usable digital bits. So the crucial point here is that Marvell doesn't just build the highways. They are also a premier design partner. Hyperscalers like Amazon and Google, they don't always want to pay NVIDIA's massive premium merchant margins if they can just design a thinner, cooler, cheaper chip specifically for their own models. Think AWS Trainium or Google's TPU family. Marvell is the foundry-facing integrator actively helping these tech giants design their very own custom compute engines. They are the ultimate dual-source and attached specialist in this space. Let's jump to section 3, demystifying the Google warrant. Time to address the elephant in the room. Following a late July 8K filing, the street completely misinterpreted this massive headline. Everyone started talking about a $120 billion lifetime ceiling with Google as if it were guaranteed, locked-in backlog. Listen to me, it is not. Treating a theoretical commercial ceiling on discretionary purchases as guaranteed revenue is exactly why retail and institutional expectations became so violently detached from reality. The strict, unyielding mechanics of the Google warrant are actually pretty straightforward. Google can earn up to 58.97 million shares at a strike price of $206.58. But to get there, one tranche of roughly 240,000 shares unlocks for every $500 million of qualifying custom revenue. This means inference accelerators, network interface cards or NICs, and memory controllers. Standard merchant optics, they do not count. Marvell has to actually deliver the silicon over the next several years to unlock those shares. It's an incredible commercial weapon, for sure, but it is not an immediate purchase order. Moving into Section 4, Financials and Growth Trajectory. Let's look at the hard numbers management just outlined. Now, what you're seeing here represents a semiconductor analyst's absolute worst nightmare. For Q3, Marvell guided for $3.15 billion in revenue, beating the street's $3.03 billion expectation. They guided for $1.10 EPS, beating the $1.07 expectation. The top line is accelerating beautifully, right? But look at the bottom line. Non-GAAP gross margin is quietly slipping backward to a band of 57.5 to 58.5%, down from 58.9%. This right here is the margin paradox. As Marvell wins more of that custom XPU business we just talked about, helping those hyperscalers build their own chips, their revenue absolutely explodes. But custom silicon mathematically carries lower gross margins than their traditional, highly profitable optical DSP franchise. So as the product mix shifts toward these massive custom deals in the second half of the year, it dilutes their profit margins in the short term. That subtle margin compression, that is the exact whisper that caused the stock to bleed, despite the massive revenue beat. Section 5, Bull Case versus Bear Case. Let's pit these two sides against each other. You are looking at the ultimate market tug-of-war right now. On one side, the bull case is betting heavily on Marvell becoming a true $200 billion growth compounder. If they can maintain operating leverage on a $3 billion plus quarterly run rate and their bet on Celestial AI's photonic fabric pays off as copper dies out, their earnings power will be absolutely massive. On the flip side, the bear case is loudly pointing to a trailing PE of around 83 times, aggressive forward multiples in the 50s, real margin decay from that custom silicon mix, share dilution creeping up past 921 million shares, and of course, relentless giant competition from Broadcom. It's a battle of narratives. Finally, Section 6, Valuation and Investor Checklist. Let's make this actionable. If we run a simplified, educational, discounted cash flow model based on their recently accelerated growth curve, here is how the math shakes out. Let's assume fiscal 27 revenue hits $12 billion and fiscal 28 scales to $17 billion. Factor in a mid-20s free cash flow conversion rate and a standard 10 to 11% discount rate. Assuming a terminal multiple of 18 to 25 times, you can mathematically justify a price target between $180 and $280. So is it a buy right now based on the DCF model? Well, with a close around $241, you're sitting right in the middle of that range. That means it is fairly valued only if that massive 2028 growth narrative perfectly materializes without a hitch. However, strictly looking at momentum and the relative strength index, the post-earnings drop actually makes complete sense. Think about it. The stock fell 37% in July, then ripped 29% in August purely on the Google headline euphoria. This recent mid-single-digit drop wasn't a broken thesis. It was simply market positioning violently correcting itself. The market basically demanded a fairy tale margin story, and management delivered a highly profitable but much more realistic hardware mix. So before you make a move, you need a strict checklist. You must rigorously monitor these exact 6 signals over the coming quarters. 1. Ensure Q3 data center growth actually continues sequentially. 2. Gross margins absolutely must hold above that 57.5% floor. 3. Look for clear transparency in the custom versus connectivity revenue splits. 4. Watch closely for that first $500 million in Google qualifying revenue to hit. 5. Ensure the diluted share count doesn't further erode earnings. And 6, all eyes need to be on their October 6th Investor Day to see if this custom growth story is actually materializing without destroying margins over their multi-year model. As a quick reminder, this deep dive is for educational purposes only and is absolutely not financial or tax advice. Always do your own thorough due diligence and consult with a professional before making any investment decisions. If you found this fundamental and technical breakdown valuable, please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. We aim to bring you the highest quality, first principles research on the market's most fascinating companies. And one more thing, please put in a comment if you want us to deep dive into any specific high risk/reward opportunities next, whether it's the next AI infrastructure play or a hidden value gem. Let us know what you want decoded. Thanks so much for joining us, and we will see you on the next explainer.